Next, girls, after depreciation, we reach the fifth adjustment now. Fifth adjustment, children, is called the accrued income. You understand the meaning of accrued? What is accrued? Accrued means receivable. It is also called income receivable. It is income receivable. Income receivable means that type of income that is still to be received. That means it is your income that has not yet been received. Receivable, it will be received. Will be received means should be added to the income. Where are the incomes shown? It is added to the income on the credit side of P&L account. It is added to the income, to whatever income is given. Maybe rent receivable. Rent receivable means it will be added to the rent. Where will that rent receivable be given? See, girls, rent received is always given on the credit side. All the incomes are on the credit side. This also is an income, is a rent that has not yet been received but will be received. Will be received means should be added. So when it is added to the income on the credit side of P&L account, it has an effect on the balance sheet too. That means it is when it is yours, it is accrued, not yet, it has not yet come, it has not yet been received, but it belongs to you. Whatever belongs to you comes on the asset side of balance sheet. So on one hand, it is added to the credit side on the P&L account. It is shown on the credit side of the P&L account, added to the respective income. And second place, it will be shown on the asset side of balance sheet. Next now, sixth. See here, like this it is shown here. In your textbooks, it is shown the income that is shown. This is the example that is shown. Commission received has been shown here as 15,000. How will you show this 15,000? Commission received is 15,000, and adjustment below that is given commission earned. It is yours. That means it has been earned, generated, but not yet received. That means it is receivable. It should be added to this income. Where will this income be shown? On the credit side of P&L account, where we show by income, add this amount of income also. So 3,000 is added to 15,000. Total amount that will be shown in the amount in the P&L account should be 18,000. And also this income which has not yet been received is your asset. It will be shown on the asset side of balance sheet. Now next adjustment, reverse of this. Reverse of this is income that has been received in advance, or it is also called unearned income. Unearned income, or income that has been received. Income, it has been received in advance. It has been received in advance. That means it has not yet been generated, not yet been earned. What is not yet earned on one place? It will be a liability. Liability side of balance sheet. It is a liability, and it is unearned, not earned, but it is added in the income. It is shown in the income, but it has not yet been earned, so it should be subtracted from the income, respective income. And where are the incomes shown? On the credit side of P&L account, on the credit side. Wherever the credit side of income has been given, there the unearned income will be subtracted from that income, and also shown as liabilities in the balance sheet. Then next is seventh adjustment is interest on capital. This brings the interest on capital. Now girls, this is, if you remember the principle, the principle, there was a principle, I tell you, that business and businessmen are two separate entities. The interest, that means the capital that has been advanced in the business, the capital with which the business is being run, that capital has been given as a loan to the businessman. From the businessman, it has been given a loan to the business with which the businessman is earning money. That is why it is, capital is always in the balance sheet. Suppose this is the balance sheet. On the liability side, this capital is shown here. Why is capital considered to be a liability? Capital, children, is a liability because we believe that businessman is a separate entity than the business. And the capital that is being used in the business is like a loan, like a liability, like any other liability, bank overdraft, interest, or any other loan from the bank we have taken. Similarly, capital also has been taken as a loan, which is used till the business carries on, till the life of the business, and will be returned to the businessman after the business is wound up. So on this capital that has been advanced, because this is we have borrowed, every borrowed capital has a figure of interest on it. So this interest that is accompanied on this capital, this will be added to the amount of capital. So the two effects of interest on capital, first will be it is added to the capital. And where is the capital? On the liability side of balance sheet. On liability side of balance sheet, it is added to the capital. The capital advance, suppose, was 1000 at the rate of 10%. This is a loan, and there is no loan without an interest factor. So this is the interest that the capital is earning. So this loan is earning this interest that adds the amount of loan, that is added to the amount of loan. It increases the amount of loan. So it is added to the capital on the liability side of balance sheet. Second, now when it is added to the capital, what is the income statement effect? The effect in the income statement, it is an expense on the debit side of balance sheet. It is shown on the debit side of, not balance sheet, P&L account. Debit side of P&L account. All the expenses, it is an expense to the business. This interest, the business is paying this interest to the businessman. So it is an expense, like rent, like salary. This interest is also an expense for the business. So all the expenses are added on the debit side or shown on the debit side of P&L account. This interest on capital will also be shown on the debit side of P&L account. Eighth adjustment. Eighth adjustment is interest on drawing. Interest on drawings. What are drawings? Drawing means an amount that has been withdrawn for a temporary use by the partner, by the businessman. It is an occasional amount that is withdrawn by the partner. Which will be returned by the business. Sorry, my phone battery was running out. Now, interest on drawings. I've told you what are drawings. Drawing means an amount that has been temporarily withdrawn by the businessman for his personal use. So, whatever the amount is withdrawn from the business, the amount, whenever it is withdrawn from the business, it definitely has an interest factor on it. So there is this interest factor on this amount of drawing. So this interest that is withdrawn by the businessman, this drawing that is withdrawn by the businessman is paying interest on that. So when this interest is being paid to the businessman, it will be income for the business. It is income for the business. Why? Because the businessman is paying this interest to the business. So for the business, it is income. Income means credit side of P&L account. And credit side of P&L account. Like all the other incomes, this interest is also an income for the business. Next, now the amount of interest that comes into the business is what is happening in the balance sheet. The amount is shown as drawings. The business has withdrawn something. The amount has been shown as drawings there. So this amount of drawing, this interest on drawing, will be shown on the liability side of it is deducted from the capital. The drawings are deducted from the capital minus from the capital. And where is the capital shown? On the liability side of balance sheet. So where the capitals are shown, it will be shown like this. In the balance sheet, here you show the capital. Where the capitals are shown, here you will add the net profit and minus the drawings. The drawings are always subtracted. So where you subtract the drawings, you will subtract the interest on drawings also. So what is happening to the interest on drawings? It is minus from the capital. And also it is shown on the credit side of P&L account. Why? Because it is an income for the business. Next adjustment. Ninth adjustment, it is interest on loan. Interest on loan. So whatever interest on loan, now who is paying this loan? The businessman has taken this loan from the business. The business has given this loan to the businessman. So the loan the business has given to the in loan to the businessman. So the interest will come back from the interest is coming to the business. So the businessman has taken the loan and he will pay the interest. So this interest on loan that is come, it is the business, in case the business has taken the loan, if the business has taken the loan, this interest will be shown. This is an expense. Then business has taken this loan. It will be, supposing interest has the business has taken a loan, it will be shown as the mortgage loan or loan from the bank at so and so percent, whatever loan is shown. So whatever is the loan is always an expense on the business. Interest on loan is always expense for the business. This is expense for the business. And all the expenses are always shown on the debit side. The two effects. First, debit side of P&L account. Why? Because this is expense to the business, and then it will be added to the amount of loan on the liability side of balance sheet. See here like this, where the liabilities here in the liability, suppose this is balance sheet. In the liability side of balance sheet, where the loan is taken here, loan from bank, you will show loan from bank. Suppose loan from bank is shown at rupees 1000 at 10% interest. That 100 interest will be added to this amount of loan. So it is added to the loan on the liability side of balance sheet, and also shown on the debit side of P&L account. Interest on loan. Why are we adding this? Why are we showing this interest on loan there? Because interest on loan is an expense for the business. Business has taken this loan. In case the loan has been taken by the businessman, then it is income for the businessman. The business has taken the interest, a loan from the businessman. Then the business is paying this loan interest to the businessman. Then it will be income to the businessman. But for the business, it will always be an expense. Are we clear? Now let us do the illustration. The coinciding illustration is illustration number 2. Here I'll show you. Illustration number 2 here. This is the question, children. Purchase and sale, return inward, return outward, carriage, the wages and salaries, trade expenses, rent, insurance, opening stock, cash in hand, cash at bank, all these are the expenses. Let us first read the adjustment. Adjustment, stock at the end is rupees 60,000. Stock at the end means closing stock. And where is the closing stock shown? The two places of showing the closing stock are credit side of trading account and also asset side of balance sheet. It will be shown, see here, credit side of trading account. We show closing stock rupees 60,000 and also asset side of balance sheet. The balance sheet, in the asset side of balance sheet, we show closing stock rupees 60,000. One effect is this, the first adjustment is done. Then depreciate fixed assets by 10%. Fixed assets will be depreciated by 10%. Let us see where are fixed assets shown. Fixed assets, purchase, return, carriage. Fixed assets here. The last item given is fixed assets. Fixed assets are given to rupees 3 lakh. 3 lakh are the fixed assets. And the interest on fixed asset, the depreciation on fixed asset is 10%. That means on the amount of 3 lakh, depreciation will be 30,000. And where is the depreciation shown? Two places. First, it is an expense. So expenses are always shown on the debit side of P&L account. So P&L account, this is a trading account, this part, and this is the P&L account. Debit side of P&L account. Depreciation on fixed assets rupees 30,000. That is 10% on 3 lakh. 30,000 will be shown here. Second, it is subtracted from the asset. Asset was for rupees 3 lakh. And 30,000 का asset depreciate हो गया, कम हो गया. It is reduced by 30,000 क्योंकि इतना asset खत्म हो गया. So that means 3 lakh का अभी तक था, 30,000 का इस बार use कर लिया. So asset that is left, the fixed asset that is left is rupees 2,70,000. 30,000 depreciation has been reduced from the fixed asset. Fixed asset was 3 lakh till now. 30,000 इस बार depreciate हो गया. How much is the fixed assets value now? 2,70,000. That is left. The next adjustment, third adjustment, commission earned but not received amounts to rupees 400. Commission has been earned but not received. That means it is yours, added to the income. Added to the income as also asset side of balance sheet. So incomes are shown on the credit side of profit and loss account. So commission rupees 1,000. Commission accrued added to the income. So we add accrued also to the income. Rupees 400 is accrued. Total income will be 1,400. The total commission on total income on commission will be 1,000 plus 400, 1,400. And second place of accrued income, this is your own asset. So accrued commission will be shown on the asset side of balance sheet. Fourth adjustment here, rent received in advance. Received in advance. Rent has been received. It has been received in advance. That means अभी तक आपका नहीं है. It is your liability. So one side it will be liability and it has been received in advance. अभी तक का तो नहीं है ना. इस साल हमने इसी ईयर के expenses दिखाने हैं. So it does not belong to this year. It belongs to the next year. आ तो गया इस year, but it is in advance for the next year. So next year वाला इस year क्यों लेंगे? We have to subtract this. So on the credit side of balance of the P&L account, we will show is at a deduction. पहले तो rent में से minus कर देंगे credit side of P&L account and then it will be shown as a liability. See here, rent 13,000 दिया हुआ है. यहाँ पे rent must have been given as 13,000. See here, the rent given here is here 13,000. So we show here rent is 13,000. The rent given is 13,000. उसमें से in advance was 1,000. So 1,000 minus करके 12,000 is the net amount of rent. And also it is a liability. That rent that has been received in advance is always a liability. It will be shown on the liability side of balance sheet. Clear? Next, allow 8% interest on capital and charge 900 as interest on drawing. Allow interest on capital. Interest on capital. Capital is given to us. See here. The capital is given to us and drawing also is given to us. 8% on capital and 900 as drawing. Capital is given to us, 8% on capital. This will amount to the interest on capital rupees 20,000. The 15,000. The capital is rupees 2,50,000. Uspe 8% and allow 900 as interest on drawings. So interest on capital pehle aa jayega. Interest on capital on the debit side of P&L account and also added to the capital here. And then drawings, interest on drawings. Interest on drawing is an income for the business. Interest on drawing will be shown here 900 and also shown subtracted from drawings. Wherever drawings are given, the interest on drawing will be subtracted from the drawings and the net amounts will be taken. The balance sheet after all adjustments tally 4,83,300, 4,83,300 and we are done. So we have covered till 9th adjustment today. Please go through the questions, the illustration and the coinciding question. Question number 1 and question number 2 of this chapter, unsolved questions, have to be maintained in your fair notebooks. Girls, please keep maintaining the fair notebooks. I'll check the notebooks when we meet in school for our practicals. Okay? Thank you, girls. Good night. Bye-bye.